in investing. So his company, Berkshire Hathaway, they've beaten every index, every stock index by a large amount of percentages over the last 50 years. So during this period, it's a massive. They've just outperformed all these indexes like crazy. And I'm going to show you. I showed you a lot of the reasons why they did in last class, but I'll show you more. And you can apply these to your own investing. And yeah, so it's very beneficial for the real world. So one of his quotes is investing in yourself is the best thing you can do. Anything that improves your own talents, nobody can tax it or take it away from you. They can run up huge deficits and the dollar can become worth far less. You can have all kinds of things happen, but if you got talent yourself and you've maximized your talent, you've got a tremendous asset that can return tenfold. Warren Buffett. So investing in yourself through like education, skills training is very beneficial because they can't really take it away from you. So as far as I'm concerned, the stock market doesn't exist. It is there only as a reference to see if anyone is offering to do anything foolish. So what he means by that is that stock market is noise. You should only be focused on investing in good businesses. So you should only want to buy good businesses and not focus on the day-to-day changes in the stock market. Because the main key to success is Warren Buffett buys good businesses. He doesn't focus on stock price changes. The business is all that matters. So yeah, so he just wants to buy good businesses, and that's really the whole key to investing. Just invest in the business, not the stock. So invest in the business, not the stock. So that's a very important characteristic here. So I'll ask the class here, can you think can you think of a good business?
I think that the good business will be something that is consistent. Like in terms of biotechnology, probably should be something that was successful in vaccines. For example, Moderna, Pfizer. They have a big future.
Yeah. Yes, exactly. That's yeah, those are good businesses and they have a good competitive advantage. So those are great examples because they have the competitive advantage in mRNA technology, and they're very competitive in the space because of their their advantages in vaccine creation. So that would be a great example, a good example, Alexandra. So yeah, Pfizer and Moderna are good businesses. mRNA technology advantage.
I'd say like Apple and Google too.
Yes, exactly. So what for Apple and Google, what are the advantages for them?
Google literally doesn't have any competition for now, at least. And
Yes.
Apple is so far ahead that it also probably doesn't have that much competition. They're all
Yes.
trophies, so I'd say they're pretty good.
Yes, yeah, great job, Didier. That was great. Yeah. Um, Google's a monopoly, and that's a big benefit to investing. Buying into monopoly is a great benefit. And then Apple has a great competitive advantage in terms of iPhones and technology. So that's great. also. Yeah, that's great. So investing is often described as the process of laying out money now and the expectation of receiving more money in the future. So at Berkshire, we take a more demanding approach, defining investing as a transfer of others of purchasing power now, with the reasoned expectation of receiving more purchasing power after taxes have been paid and nominal gains in the future. So what he says by that is like he wants to pay. So he invests with the expectation that it's going to go up in value. That's basically what he is referring to. So there are a few different. This is all related to a lot of like the business being what you invest in. So I'll put this in the chat. So what he says is all we want to buy is to be in businesses we understand, run by people whom we like, and priced attractively relative to their future prospects. So investing in what you understand is key, because if you don't understand what you invest in, you won't, like, there will be potential fraud and criminal activity that could happen because you wouldn't be aware of it due to a lack of understanding. So that's a big problem with not understanding what you invest in. So crypto, like with FTX, people who invested into FTX, this crypto coin, they didn't like a lot of them didn't understand the business. Like I wouldn't say all, like some probably did, but a lot of them didn't understand the business and they lost money because there is a lot of potential fraud that could take place in this industry. And yeah, so that was something that happened. So investing in what you understand is very important. And then run by people whom we like. That's very important because you need people you trust. Trust is so important in investing. Like without trust, everything breaks down. If you don't trust somebody in investing, they could commit fraud, they could steal money from you, and that does happen a lot. And so you need to trust who you're working with, and then price attractively relative to their future prospects. So you want to pay a fair value for the business. You don't want to pay too much for the business. So that's very important. And then I buy businesses, not stocks, businesses I would be willing to own forever. And invest within your circle of competence. It's not how big the circle is that counts. It's how well you define the parameters. So yeah, invest in what you understand. And then when management with an excellent reputation meets a business with a poor reputation, it's usually the business's reputation that remains intact. So yeah, having a good reputation of management is really important. So having trusted and transparent management is key. So that's very important here. And then here, this passage here, it talks about how so it goes through how stock prices change constantly and they go up and down a lot, but the value stays the same if the business hasn't changed. So if you know the business has remained the great business that you saw previously, even and while the stock price is going up and down, investing is a good option because the business is still great. So yeah, the up and the stock going up and down in value is irrelevant. You should only focus on the business. Focus on how the business is doing. So that's very important. So focus on how the business is doing. So, but the problem is most people don't follow that. Most investors sell when there is bad news. However, not all bad news will impact the business's operations. So that's a big point. So you need to determine if bad news will impact the operations of the business. So that's really what you need to determine. If it doesn't, keep investing. If it does, sell. So you need to make that determination. And a lot of people, most people sell when there's bad news because they assume all bad news will affect the company's operations, profitability, revenue, cash flow. So that's a bad assumption, and a lot of people lose money because of this. So if the market is dropping, you can buy the stock at a cheaper price if the business is still the same. And then, like I said, recognize that the majority of investors play with a short-term investment game. So most people sell when there's bad news. And you can be the one that doesn't sell when there's bad news because you know that it's not going to affect the business. People sell on bad news. Companies that have a franchise product and thus a competitive advantage have the economic power to weather most bad news storms. So like Alexandra was saying, Pfizer. So Pfizer and Moderna have the competitive advantage of mRNA vaccines. So they can have the competitive advantage over companies like trying to think, I think J&J, which doesn't have mRNA vaccine technology, I believe. Correct me if I'm wrong if J&J does have mRNA vaccine technology, but if I believe they don't, but I could be wrong.
They have adenovirus.
Oh, they have adenovirus. Okay. Thanks, Alexandra. So yeah, so Pfizer and Moderna have a competitive advantage because they have a very effective mRNA technology, but other companies may not have it. So Pfizer and Moderna would have that advantage in that case. And yeah, it's a very great new vaccine technology, and it's been around for I think since the 90s, but they perfected it recently. But yeah, that's so they would be a good investment because they have mRNA technology while some companies don't. And then always invest in companies with a long-term durable competitive advantage, which we call a franchise product characterized by a few or no substitutes, product in demand by many, little or no government regulation. So that's a very important point here. So here I would say that Pfizer and Moderna fit this criteria. So they have a long-term durable competitive advantage, franchise product. So few substitutes in mRNA technology, and it's a product in demand by many. So like every person in the population. Yeah, so they do have a lot of government regulation on it, but it doesn't really impact their their profitability. Can you think of any other? Can you think of any other products that have few or no substitutes in demand by many?
I was gonna say the Elon Musk company, it was about to crash all the time, but they kept pumping money into it, and it was very, very sustainable, and now it's super high in stocks. So this is a good example of if you really like the idea and support the idea, and people will be willing to get your stocks. So
Yes, that's a good example. Like Tesla, yeah, Tesla, good example.
the chips that
Um,
they're going to introduce to the brain and stuff like that. And then the SpaceX.
yes, good points, Alexandra. Yeah, so like yeah, Neuralink, and SpaceX, very few substitutes.
Would Nvidia count or no? I'm not sure.
Yes, Nvidia would count, for sure. Yeah, Nvidia would be a good company also. There are very few chip providers. So Nvidia, few substitutes, product in demand
Yeah.
by every computer and mobile device. So yeah, good points there. All of those are good investments the based on the competitive advantage they have. So yeah, Nvidia, Neuralink, SpaceX, all those ones. Yeah, good investments. And Pfizer, Moderna, yeah, all great investments. Can anyone think of any other products that would fit that criteria?
I'd say Netflix used to be that, but not anymore. So I don't, I can't think of anything else.
Maybe food production, something like, and Johnson & Johnson will be a good example in terms of hygiene products. They pretty much rule the North American market, including the pharmaceuticals. They produce big chunk of it. But I cannot think of an exact company for now. I don't know, just McDonald's. It's a very big brand for fast food. It's the most distributed fast food all over the world, actually.
Yeah, good points. Yeah. So yeah, Didier was right. Netflix used to meet all that criteria. And then the problem was so many streaming services came in, but they for a long time they ran that market. And it was a monopoly for a while, and then it's more monopolistic competition now. Um, and then Alexandra's point with J&J dominating the hygiene market, that would definitely fit. High demand product, not a lot of substitutes if they dominate the market. McDonald's, that's very good because they have a marketing advantage because their brand is just, it's so integral to society, and it's very in demand. So yeah, good points everyone on that.
Would Amazon count or no?
Yes, it would. Yeah. Amazon's substitutes are Shopify, eBay, and a few others. However, Shopify has had a very difficult few years. The company has been burning hundreds of millions of dollars through higher costs. eBay has been shrinking. Walmart, Walmart's website hasn't gained as much traction in growing. So yeah, that's a good point, Olivia. Yeah, Walmart. So sorry, Amazon would be a great. Like I currently own a bit of Amazon, and it's a good investment because there's fewer no substitutes. It's in demand by almost everyone. Yeah, so that's a good point. A great point there. So if you have a great business, if the stock goes down like this here or like this here, you buy. If the company is a great business, buy when it is cheap. So that's very important. So if it becomes cheap, then buy. So that's a very good strategy there. Like once it becomes cheap, just buy. Yeah. And then here, the essence of what Warren Buffett does, driving force of Warren Buffett's investment strategy is the rational allocation of capital. To determine how to allocate a company's earnings is the most important decision a manager will make. So rationality is the quality Buffett most admires. Buffett's success has been dependent on as much on eliminating those things you can get wrong, which are many, i.e. predicting markets, economies, and stock prices, as on getting things right, which are few and simple, valuing a business. There are two simple variables Buffett focuses on: the price of the business and the value of the business. So you want the price to be fair / discounted for a high value business. So that's very important. So you want that to happen. You want it to be fair, the price to be fair / discounted for high value business. And that will be key to your investing. So you don't want to overpay. You want to make sure it's a fair or discounted price. Yeah, as long as it's fair or discounted for a high value business, you're going to be okay. So ways to, yeah, a lot of what he focuses on, turn off the stock market. Remember that the stock market is manic depressive. So what they mean by that is it goes up for weird reasons and it goes down for it goes up for people buy for unknown reasons, they sell for unknown reasons, they panic and sell. There's a lot of reasons, a lot of unknown reasons why the stock market goes up and down on a given day. So that's why it's so important to buy into a business, not look at the stock price day to day, because the stock price goes up and down for unknown reasons constantly. That's why if you buy a business and you hold it and don't look at the stock price, that's the best way. So with my investments, I just hold them and I don't check on them for months on end. And that's how it should be. You should, one of Warren Buffett's quotes is, you should invest like the market will be closed for 5 years. I like that quote because you should invest for the long haul, because the value will show after a long term period. The value of the stock won't show immediately. So you just have to be patient. And don't worry about the economy. Buy a business that has opportunity to profit in any economy. So can you think of a business that will profit in any economy?
Probably like medical production. Maybe a company
Yes.
3M. They produce a big chunk of all of the technical equipment and stuff like that. And then primary needs like foods and stuff like that. So all of the primary ones.
Yeah, that's great. Yeah, great examples. Yeah, medical technology, foods. Yeah, those are recession proof. Yeah, that's great. Like they'll do well under any economy. That's great. Any other examples?
Would like transport business be a thing or no? I'm not sure.
Oh, that'd be a good one. Yeah. You need transport for food and any other goods constantly. So that's a great example. Yeah.
I like fast food chains like McDonald's.
Yes, exactly. That would be recession proof. That's great. That's great. Yeah, excellent examples. And then buy a business and not a stock. Change your perspective to that of a business owner and learn as much as possible of the business and industry. Very important. That's the key. That's his main focus as one. That's his main focus. And then I disagree with number four. Number four is not like I disagree with it. It's just my view. I think that diversification is key because so diversification means so the definition is owning companies from different industries. So it's key because if one industry has a bad year, you have companies from other industries. So like I owned some crypto companies last year and the industry had a bad year. But I owned companies in the banking, railroad, technology, and car industries. So my so I was okay because because I because I owned things in other industries, owned companies in other industries. So like that's the key. Spread your investments over a few different industries. Just in case one industry goes bad. So that's a very important strategy. Warren Buffett doesn't believe that, but he would even admit that some of his investments have had bad years and bad few years, etc. So it's happened to him where he's had bad investments, like in certain companies, like banking. He's invested in banks, and they've done poorly. So it's happened to him too. And if he didn't diversify, he would be really in trouble. So make sure you own companies from different industries. So that's very important. And then your concepts that every investor should know. So yeah, when interest rates rise, business becomes more difficult and vulnerable. This is due to the high cost of borrowing money to invest in the business. When interest rates decrease, it's easier to borrow capital, therefore expand capacity and activity. Hence, interest rates are the price of borrowing capital of business in finance. So you don't need to know about the before and after tax costs of borrowing capital. So here, inflation. So inflation is a big problem that we deal with. So like the example here, so let's say you make $40,000 a year. Let's say you make $40,000 a year. Inflation is at 10%, let's say. So let's say it's at 10%. And then using the rule of 72 to show how many years it will take for the 40,000 to be worth half of what it was in the current year based on inflation. So based on inflation, the value, so based on inflation, the value of the 40,000 will go down over time. So in this case, if you did that, you would take the 10% of inflation in the 72. So you do 72 divided by 10, get 7.2. So it takes 7.2 years at 10% inflation for the $40,000 today to be worth $20,000 in 7.2 years. So that's the problem with inflation. Like your salary with no wage, with no raise will be worth much less over time due to inflation. So this is what would happen here. It's pretty brutal how that happens. So yeah, if inflation was 10% per year, this is what would happen. And it's pretty brutal. That is one of the reasons why we invest, to protect our money from inflation. So common stock is an inflation hedge. So the S&P 500 here, the returns, as you see here, they're more than 10% over these durations. And then here the inflation is about 3 to 5%. So if you invested in S&P stocks, you would make more than enough to beat inflation. So you want to have a higher return on your money than the inflation rate. So one of the ways you can do that is through investing in stocks. So so that's very important. So investing in stocks is one of the ways you can beat inflation, because some jobs don't have raises. The unfortunate part is that some jobs just don't have raises, which is just terrible, because the amount of money you lose from inflation is just astronomical. So we're gonna skip. We'll get here. So post that in the chat for everyone. So here, if we look at an income statement, this is a good way to determine if you want to invest in something. And I'll show you what to look at. So here, you want to look at, on this one, net income is the most important thing here. So I'd recommend look at net income. Net income is very important. Yeah, I would say net income is very important out of all this. Yeah, I would say that all you really have to look at for this one is net income for the most part. And then check if any of these expenses are going. So maybe like research and development, it's going up. It doubled, almost doubled during this period. So that's kind of a good sign. So here they are investing in more product improvements, which is good. And then net income has gone up, so they're making, so the net income has gone down here. So net income has gone down from 2012 to 2014, which is not a good sign. So that's not good. We want it to be increasing for it to be a good investment. So that's not a good sign for us. So So that's how you read an income statement. The net income is really the most important takeaway. Look at the net income, and it should be increasing for it to be a good investment. And then the balance sheet. So the balance sheet is another thing you look at. I'll show you what's important on the balance sheet. So cash and cash equivalents is really important on the balance sheet. So you want to look at that. You want cash. You want this to be increasing. Should be increasing. Here. So you want that to be increasing. Also, other things that you want to be increasing in this case is so stockholders' equity. So you want stockholders' equity to be increasing. So you want both of those to be increasing for it to be a good investment. So those are things that you have to look at so you can look at that for any stock on the public markets. So Pfizer, Moderna, Walmart, Nvidia, all of those are public companies, and you can find their balance sheets on places like Yahoo Finance, Google Finance too. So you can find this information on there if you search for them. So that's how you find that data. And then this data here, so the ratios. So here, so I just posted the balance sheet into the chat, but the ratios, so the current ratio is very important. You want to have a current ratio. So for me, I think for me, having current ratio of 2 or more is good. So I think having it 2 or more is good. So current ratio means current ratio shows if the company can cover short-term debts. So the higher the current ratio, the higher probability of the company covering short-term debts. So that's what it is. And then also with the other indicators here, you want to have a debt to equity ratio, lower the better. So in this case, debt to equity ratio should be 0.5 or lower. So it shows so debt / equity shows the long-term debt to equity. So lower the better, because there is a lower amount of long-term debt that you need to pay off. So lower the better. I would say 0.5 or lower is really key. And then net profit margin is also another good thing to use. So net profit margin, you want to have a high net profit margin. So you want the net profit margin to increasing. So it should be increasing or stable. So you want either or here. And then return on equity is also another important stat. You want return on equity to be high. So ROE, return on equity, should be above 15%. So in this case, it's 30. So that's 0.353. That's 35.3%. Any decimal like that is just percent, and 30%, and then 35.4%. So here, return on equity is pretty high in this case. So that's good for investing in Apple here. So I'll show what I'm going to do next is I'm going to show a video on what return on equity is. Does a good breakdown on what it is for everyone. So I'll bring that up here. So here, the basic ideas of investing are to. So the basic ideas of investing are to look at stocks as businesses, use market fluctuations to your advantage. So what they mean by that is buy good businesses when they go down in price, and then seek a margin of safety, buy a good business for a fair price. So that's very important to investing. And yeah, that's really the core, that's really the root of his strategy. So then these are the types of questions you can ask when you're doing your final report / when you're investing. When you're analyzing a business and determining if you want to invest in it, ask these questions. So is the business simple and easy to understand? That's a very important question, because the problem is if it's not easy to understand, they could potentially be lying to you and defrauding you out of money. And that's a big thing that does happen with people that don't understand what they're investing in. They could be investing in something that that is a total fraud. Does the business have a consistent operating history? So you want to ensure that it has a consistent operating history where it's not going up and down constantly, and there's a lot of issues in management, a lot of changes, constant change. You want to have something that's been stable. Then also, does the business have favorable long-term prospects? So you want to make sure that you ask those questions. So you could literally use these as potential headings for your final report if you want. / answer these questions in the content. These could be potential headings, and these are great questions to ask for potential investment. Then, is management rational? So that's a great question. There's a lot of situations where the management is not rational. Recently with FTX, the crypto company, the management was clearly not rational, and it was very problematic, because they were doing a lot of stuff that management shouldn't be doing. So analyze the character of the management and how they operate. And then, is management candid with the shareholders? Are they being honest and trustworthy? So honesty and trustworthiness are very important. And then, does the management resist the institutional imperative? So that means that does the management change? Do they accept new ideas? Do they want to improve their business? That's what you really want out of a management. You don't want a management that wants to keep doing the same thing over and over and imitating other competitors. You don't want management like that. Also, focus on return on equity, not earnings per share. So yeah, focus on return on equity. That is so key. So look up what the return on equity is for a potential investment that you want to do. And yeah, like determine if it's a good return on equity. If it's more than 15%, that's really what you want. Calculate shareholders' intrinsic value. So determine if the business is worth more than the price. Look for companies with high profit margins. Make sure the value added is greater than 1. What is the intrinsic value of the business? So intrinsic value means what the business is worth, like what the business is actually worth, not the price of the business, what the business is actually worth. And then, can the business be purchased at a discount to its market value? That's important. It's good to buy at a discount, but if you can buy it at a fair price, I recommend purchasing it. So buy it at a discount or a fair price. Don't overpay. So Warren Buffett way, is the business simple and understandable? Does the business have a consistent operating history? Does the business have favorable long-term prospects? Is the business simple and understandable? Does the business have an identifiable, durable competitive advantage? So knowing if it has a competitive advantage is so important. If it has a competitive advantage, it can stay dominant for a long time. And then, does the business have an identifiable consumer monopoly or franchise product? What is the chance the product will become obsolete in the next 20 years? So you got to look at that. You got to look at if it's going to become obsolete. Kodak went obsolete because they monopolized the film industry, and the the physical film industry when everything was going digital. So you got to make sure that the product that they have is not going to go obsolete in 20 years. If it is, they have to have a plan to transition to the new product. Then also, if the company has a consumer monopoly, that could be a good potential opportunity. And then is the business simple and understandable? What does it mean? Does the business have a product that's simple and complex for the average investor to understand? So See's Candy is a candy company, and it's not like it changes that much. Candy doesn't really change that much. So the competitive advantage that See's Candy has is probably going to sustain itself because candy is candy, right? It's not going to change into something completely different. While Intel, a technology product, like after a while, they're going to have to completely change the product because technology changes constantly. Candy's different because candy is candy. It doesn't really change that much over a long period of time. So based on this graph here, this chart here, I'm just going to zoom in so you can see it better. So I'll zoom in here. And I'll ask the question, does this company have a consistent operating history?
I'd say that it's a good company overall.
Yes, exactly. Yeah, I agree. So one of the reasons why, a good job, Alexandra. One of the reasons why is the cash flow per share. It went from $1.02 to $8.09 during this 2009-2014 period. So it went up 8 times during that period. And the higher cash flow per share is a very good metric for us. We want higher cash flow. And then that's good for us. Also, their book value per share. So book value means, so we want higher cash flow. And then book value per share, that just means shareholder equity per share. The book value per share went up from $4.42, $19.02. That's good for us as investors. And then the return on equity went from 20.49% to 35.42%. So it's a higher return on equity. So by 2014, they were getting a 35.42% return on their equity, which is very high. So that's very good. So it is a good investment. And then also the owner's cash flow down here, it went from 5,273 to so that's in billions, so it'd be 5,273,000,000 to 37,894,000,000. So it went up by a significant margin. So that was so it is a good company to invest in that case. So yeah, so that's great. So an investor needs to do very few things right as long as he or she avoids big mistakes. We like stocks that generate higher returns on invested capital where there's strong likelihood that it will continue to do so. I look at long-term competitive advantage and whether that's something that's enduring. So Warren Buffett way, management tenants, is management rational? Is management candid with its shareholders? Does management resist the institutional imperative? Very important questions. So when you have able managers of high character running businesses about which they're passionate, you can have a dozen or more reporting to you and still have time for an afternoon nap. So you want to, in evaluating people, you want to look for three qualities: integrity, intelligence, and energy. So integrity is the most important. So integrity is the most important, quality in a manager, in your company's workers. So what is your definition of integrity?
I'd say integrity is honesty and professional standing as a good practice, as a morally acceptable and good practice kind of thing.
Yes, yeah, exactly. Yeah, that's great. Yeah, so that's exactly it. So that's the number one thing you look for in an investment. Number one thing in investing is integrity. So without integrity, everything else that about the company can potentially fall apart. So you need integrity, because without integrity, situations like Enron take place. So yeah, situations like Enron will take place. So in the long run, of course, trouble awaits managements that paper over operating problems with accounting maneuvers. So they start lying on their accounting and doing a lot of tricks like that. And yeah, you need integrity in your management to avoid those problems. So then the institutional imperative is focused on the company doesn't want to change. They just soak up money. They they just uh they just imitate the competitors. This becomes a problem because the companies that succeed in the industry are companies that create new standards. So Apple, like big examples, Apple created new standards with the iPhone and completely set a new standard for the industry. While BlackBerry had the institutional imperative, where they resisted change, and then they tried to imitate Apple with no success. So institutional imperative is not good for an investment. Can anyone think of another example of institutional imperative?
Maybe McDonald's and KFC. I am not sure who created it first, but something like that.
Yes. So yeah, good point. So that's a good example. So institutional imperative happens in like fast food. Yeah, institutional imperative, fast food, like one, so like all of, so like KFC in that case, KFC tried to
Or
imitate, sorry.
an expensive clothing brand and Zara, which takes all of the conventional trends and makes it to like spread out fashion that is accessible. Stuff like that, probably.
Yeah, those are good examples. Yeah, yeah. So anything that they imitate another company just to try to compete, you can't, like the problem is they can't, it's sometimes they can do it through a low cost imitation, but in a, sometimes they're successful doing this, and some companies have been successful, like maybe making a low cost alternative to another product that can work. but with BlackBerry in that case, they were not successful in doing that. But Zara are they successful in doing that?
I'd say yes, they're super successful because
Okay.
people want to have access to fashionable items but are not able to purchase them. So they just replicate all of the fashion trends, and they're successful because there is obviously more people who can afford Zara than higher fashion brand or something like that.
Would Facebook categorize as this then, since it like imitates a lot of like what other companies were doing now? Like it created something new at first, but now it's like mostly imitating. Is that like is it switching to institutional?
Yes, yes. This can actually work in those cases. Like Alexander talking about Zara, that this would have worked in that situation. And then also Facebook, yeah. So Facebook imitating like TikTok with Instagram shorts, all that kind of stuff. YouTube also doing this with shorts. It can work in a lot of cases. And if it's I think it can work if they do it very strategically. And it seems like all these companies did. If they do it very strategically and clever, they can get it done. So like as Alexandra and Didier said, those what they did there was very strategic and it seemed like it worked. So yeah, good examples there.
I
Does
think it
anyone
was
else?
like, oh, yeah, I was gonna say, I can't remember which company it was. Like either Amazon or Google tried to make their own like uh gaming console, but they ended up pretty much like canceling it after a while because it wasn't making money.
Yes, yes. Yes, so like imitating PS and Xbox, yes, like they could potentially do it, but I think in that case they their strategy may not have worked. Um yeah, so like that was a good example of like they may not been able to craft a strategy to compete. So a good example, Zachary. So I think this can work, but they have to be very strategic about it. Um, so yeah, there are instances of this working and instances of not working. I think it's just based on strategy.
Would
So
this also apply to car companies, like where one company would put some safety feature in their car, then within a couple years, all the other ones are doing that as well?
yes, yes, 100%. That would be a good point, Olivia. The Yeah, car companies also with electric vehicles, like all of them are like GM, Ford, Mercedes, BMW, they're all making electric now and all the other ones. And that was kind of the first one that really was mainstream about it was Tesla, but it seems like all the other ones are catching up. And this does work a lot. And it seems like Ford and GM are getting pretty competitive with the electric vehicle design. So the institutional imperative is not always a bad thing. Um, it seems like the good thing about it is it kind of sets a new standard for the industry and all others follow. So good job on finding all the situations where this would actually be a good thing.
I was wondering, so does it mean that like because all the companies I just said would be like companies that have disposable money, like would that be like a factor with why it worked for them? Like they can spend a lot of money to like get up to speed with other companies or something like that. Like it wouldn't work for new companies to imitate the same thing because they probably have not enough money to do it. Maybe that would be a thing. Or
Yeah, that's a great point. To imitate a competitor like Tesla, for example, you're gonna need pockets of cash. Like what you said, Ford, GM, Mercedes, BMW, all those companies, they have so much money lying around that they can invest in this kind of thing. But yeah, like you said, it'd be very hard for a small company to, imitate other companies. But yeah, having deep pockets would be a good, like, if you have a lot of money lying around and you can get loans, get investment, that really provides an advantage in imitation. So that's a good point, Didier, on that. So yeah, good discussion on that. Like, it seems like this is not always a bad thing, institutional imperative. So for your final project, and also any investment research you do, find out what the return on equity is and what the company's owner cash flows are. Return on equity and cash flows. So return on equity and cash flows are the most important statistics to look at when you are researching investments. Higher and increasing, the better. And then also, what are the profit margins? That's important too. Has the company created at least $1 market value for every dollar retained, value added? Does the company have less than 30% debt? So I think this is the most important slide in this slideshow. So I'll post it in here. Most important slide on income statements, balance sheets. Yeah, so look at those. So if you incorporate that in your final report and in your all your investment research, if you can find all this information, that'd be great. So yeah, here this here, let's highlight the information on long-term debt here. So wait, I have to find the other stat. So owner cash flow here, it's increasing a lot over time. Also, return on equity, it's pretty high here. And then debt to equity ratio, I'll try to find that where that is. Yeah, I'm not sure if it's on here. But they have long-term debt and shareholder equity right here. So what I'll do is just gonna highlight all these. So right here in 2014, the long-term debt to shareholder equity, it's probably about 25%. So that's pretty good. So it's around 25%. So that's pretty low for us. So it'd be about 25% for long-term. So long-term debt to equity, 25%. So that's low. And then return on equity is 35%. That's high. Then owner's cash flow went from 5 billion to 37 billion during that period. So it seems like this is a pretty good investment based on all these stats here. So yeah, the ROE is return on equity 35.42%, high. And then cash flow increased by 32 billion from 2009 to 2014. So it seems like it's a good investment based on those stats. Those are the most important stats here. There's other important stats, but I would say these are probably the most important. So I'll post that here. So then value tenants. What is the business's value of the company? That is the intrinsic value. Can the shares be purchased at a significant discount, roughly 50% to its current trading price. That's going to be very hard. It's very difficult to find a good company that's trading at 50% of its current trading price. So I would say buy it at a fair value. If you can buy it at a discount to what it's worth, that's great. But if you can buy it at fair value, buy it. So buy it at a discount or fair value. So then Buffett's 4 principles of investing. The company must have capable and vigilant leaders. Company must have long-term prospects. The stock stable and understandable. Company must be undervalued so you can make a good buy. So you want low debt to equity ratio of less than or equal to 0.5, and a debt to total assets of less than or equal to 0.3. So don't worry too much about the debt to total assets here. Just look at debt to equity. So you want it to be less than or equal to 0.5. Then high current ratio of greater than 1.5. Strong and consistent ROE, return on equity. So Buffett requires 8% average over a 10-year period. Cole likes to see an average of 15%. So Apple had it over 30%, so that's very high. And then appropriate management incentives. So you want management. So you want management to have stock options and bonuses for improved performance on the stock slot, like on the like, let's say cash flow, like net income, cash flows, stock performance, and other metrics. So you want that there. So these are important stats to use when you're analyzing company too. You can potentially use for the final report too. So here, current ratio. So current ratio is the ability of the company to cover short-term debts. So 1.5 or higher is what Buffett wants. And then debt to equity less than 0.5 is ideal. ROE greater than 15% is ideal. So I'll ask the class here, does this spreadsheet here meet those characteristics?
I would say no, because their debt equity ratio is going up and ROE is less than 15%.
So good job on the debt to equity ratio. I'll clarify the ROE one here. So for this would be so it's in decimal here, but this would be the same as 35.3%.
Oh, okay.
Oh, it's okay. That's okay. So this would be 30%. This would be 35.4%. But yeah, that is confusing with because some of these numbers, they wouldn't be in percentage form. So again, it does get confusing because price to earnings ratio is not in percentage. So but yeah, like here, yeah, good job on the debt to equity.
And current ratio is also going below 1.5, which is a bad thing.
Yes, exactly. So yeah, the current ratio is too low. They may not be able to cover short-term debts. And then debt to equity may be getting too high. And then return on equity is very high and stable. So that's good for, so the last thing is good for investors, but the other two are not good. So the current ratio is too low, debt to equity is too low, too high, and return on equity is very high and stable. So when you have able managers of high character running businesses about which they are passionate, you can have a dozen or more reporting to, and you still have a time for an afternoon nap. Evaluating people, you look for 3 qualities: integrity, intelligence, energy. Integrity is the most important. In the long run, of course, trouble or waste management, that paper over accounting problems with accounting maneuvers. So like what I said, if they don't have integrity, they could be lying on their accounting, which is a big is very legal. So people it's very against the law. So you want a company that has a product that's going to keep its competitive advantage very far into the future. Yeah. So one of the companies that Warren Buffett invests in that has a competitive advantage that's going to go very far in the future is Coca-Cola. Coca-Cola's product is unlikely going to lose its dominant position like anytime soon. So he likes companies like that they will not go out of business anytime soon. Like their product is not going to go anywhere. The franchise product is a durable product with a competitive advantage that's sustainable over the long run, 5 to 10 years, in demand by a large segment of the market, little or no close substitutes, little or no government regulation. So this is investing in a product like this, investing in a company that has a product like this is ideal. So you want to invest in companies that fit these criteria. I would say government regulation, like yes and no. I think there are a lot of products that fit these criteria and have a lot of government regulation. So like vaccines, for example, anything in medical has high government regulation. They can still have little or no close substitutes, high demands, and very sustainable competitive advantage. So I disagree with the little or no government regulation point. It could have high government regulation, like vaccines, and still be a great thing to invest in. So yeah, franchise product, this example, so Apple, they have a competitive advantage, but they need to keep investing in our research and development and build new products that replace major products already in the market. So there's a lot of uncertainty to Apple because there's a lot of competition in tech. Tech's always changing. And then so buying a company like Coca-Cola, there's less need for technology improvements because the product is pretty much the same it will always be pretty much the same. So that's a big benefit of investing in companies like Coca-Cola and See's Candy. So like they're not going to change that much, and you don't have to worry about investing to make it more competitive every year. So you want to so when considering a new investment, you should think about if changing technology will really change the demand for that product in the future. So you want to see if the product will be competitive 10 years into the future. So when Buffett says he doesn't understand a business, he sometimes means that he knows how it works, but he doesn't know what the future looks like. So he likes the simple businesses, and like Coca-Cola will always be competitive, while Apple and Google, there's a lot more uncertainty to the future of Apple and Google. So to look at this chart is very useful because it shows you the benefits of investing in a stock. So let's say you invest $50,000 into 10% investment and hold for 20 years. This is the breakdown of how much money you would make. So the $50,000 would go to $55,000 the next year, and then 60,500 the next year. Then after that, so on. And then after the 20 years, you would make $336,375. So this is the big benefit of investing. This is how much money you can make through holding an investment and not selling it over that period. So this is a big benefit of investing. You can make almost 7 times on this investment over a 20-year period. So this is why people have to invest, because these are the types of returns you can get if you buy and hold an investment. So I'm going to share this. So these are the benefits of investing. So yeah, holding diversified investments in your portfolio with an average 10% year return. So that's the benefit you can have, and it's so much better than leaving it in cash, because the problem with cash is that inflation eats away at cash. So leaving your money in cash, inflation eats away at the value of cash. Putting your money into investments, you protect your money from inflation and gain a lot of return. So that's the benefit of investing right here. And then this is compared to you invest $50,000 into 10% investment and sell every year. So you would make $200,847. That's still pretty good, but you would make less than if you just held it. So this is the difference between this is the difference between this is the difference between holding your investment and selling each year. So there's a pretty big difference between just holding it and selling each year. So yeah, just holding it, you'll make so much more money in this case. So I'll put this in the chat for everyone. And also it's in the PowerPoint that I posted under March 16th. And then comparison of hold strategy to buy sell strategy. Hold strategy, you make $293,419 after taxes. And you make, for the buy and sell strategy, you make $200,847 after taxes. So it's about a difference of roughly $100,000 in this case. So yeah, so this is a great breakdown of how much money you can make investing. So then this is another great slide of Warren Buffett. So according to Buffett, what causes risk? Excessive debt. Buffett never considers a company that has a debt/total asset ratio greater than 30%. So you don't want a company that has a debt/total asset ratio greater than 30%. And then overpaying for an investment. The price you pay for a stock should have a potential of at least 50% premium. That is, for every dollar you spend for an asset, you should get at least $1.50 intrinsic value. Not knowing what you're doing. That is not knowing the company, what they do. So those are risk factors that you got to watch out for so they don't take place. And then these are some of the quotes that Warren Buffett has. A lot of his quotes are very similar to the advice that we went through this PowerPoint on. So these quotes are available on the PowerPoint. I'll show you where they are if you want to